Hi guys, as promised, I wanted to do a little bit of an update on volatility, and specifically what I'm going to talk about for just a few minutes is the VIX, which stands for the Volatility Index. So without further ado, let's go ahead and look at a couple of screens. First, I wanted to make sure everybody's on the same page to make sure you understand what the VIX is or what it represents. The VIX, or the Volatility Index, is a measurement of the amount of fear that is present in the market. A higher VIX means that investors are worried about the future, thereby pushing equity markets lower. A lower VIX is just the opposite. It implies less fear and typically predicts a rising market. So I want you to understand the VIX chart is an inverse chart, which means that when the chart goes down, when the VIX goes down, that usually means the markets are going higher. And obviously the opposite is also true. When the VIX is going up, markets are going lower. So at the end of the day, this is an inverse chart. So while the VIX is not perfectly correlated, and I do want to make sure everybody understands that there are moments, and we actually saw them last week, there are moments where the market goes up and the VIX goes up at the same time, or maybe the market goes down and the VIX goes down as well. It does happen. It's rare, but it does happen. There's nothing really to be taken from that, by the way. It doesn't necessarily mean anything's going on. Just simply, it's not a perfectly correlated chart. Therefore, sometimes you do have some kind of weird things happening. But for the most part, it is an inverse chart where if one is going up, the other has to be going down. So a rising VIX implies a falling market, and a declining VIX implies a rising market. And this is a good example of the VIX over the last, I think I went back to June of 2022. So you'll notice that at some point in late June, early July, the VIX started falling fairly consistently. That means, by the way, we're in a rally in the markets. Now remember, this is an inverse chart. So if the VIX is falling, the market is going up. And we did. We had a rally. We had a really strong rally through the early summer. But that rally kind of ended somewhere about August 15th. I don't remember the exact date, but it was right around the 15th of August or so. And then that rally stopped dead in its tracks and went the other way. So the VIX started climbing. The VIX climbed right up through October. So the VIX kind of goes up from, let's say, mid-August up through the 1st of October. That means the markets are again coming back down. So we were retesting, and we'd been talking about it during that time. We were retesting some of those previous lows. And then, of course, you get into late October, or let's call it mid-October, and again, the opposite starts to happen. The VIX starts to fall again. That means the markets are rising. So we had a big rally, and we talked a lot about that rally. So you can see that rally lasted right up until about the 1st of December. The 1st of December, though, there's a transition here. There's no clear direction in the VIX. So the VIX has shown a little bit of propensity from in early December to go up. We had a little bit of since the 1st of the year, we've had the VIX kind of coming down. Overall, we're getting mixed messages in the VIX. And that just simply means that there's no real direction in the market in terms of something that is sustainable. I personally believe, and this is just a belief, it's not based on anything that I'm looking at, just I believe that we're probably going to head back down fairly shortly. I don't know what might precipitate it. It could be an interest rate increase coming 1st of February. Maybe the Fed does 50 basis points and shocks the market. I don't think that's going to happen. I still expect a 25 basis points increase. But who knows? At the end of the day, the Fed, the Fed is the Fed. They could do whatever they want. But we are right now in a downturn on the VIX. And the VIX is down in the 1830 range. We haven't seen this low of a VIX in a while. In fact, I have a screen on that. But I want you to understand that as the VIX goes down from these levels, trading, we have to change our strategy a little bit in terms of trading. We're not going to hold a position for as long. We can't. The market is much more, those runs that we look for in the markets don't last as long. So instead of a run lasting maybe an hour, hour and a half, it might last 30 or 40 minutes. So you get into it. And by the way, even though it's lasting 30 or 40 minutes, it doesn't go up that much. It might go up 5 points in half an hour, whereas when the VIX is high, you might get 56 or 50 or 60 cents moved in 10 minutes. So the lower VIX kind of makes trading a little bit harder in terms of not so much the profits, because there's ways for us to deal with it. But what we end up doing is taking shorter positions, um, bigger amounts of money potentially, but for shorter terms. The amount of time we're exposed to the market would be shorter, simply because the market just doesn't have enough time, or those runs aren't long enough to stay into a trade for a very long time. So a couple of points here on the VIX. Right now, the VIX is at its lowest since January 13th of 2022. That's about a year ago, almost exactly from Friday. So a year ago Friday, we were at the lowest, and here we are again at the low. I don't read anything into that. Whether it's going to go higher from here, I don't know. There's no way to predict what the market's going to do. It's Brownian motion, so the market's going to do what the market wants to do. On Friday, the VIX was down 4%. And more than 16% for the week. So the VIX is kind of coming down pretty hard. Now that tells me a couple of things. It might be time for us to start thinking about getting back into the market. So I am kind of working on some things about what kinds of things could we get into to get back into the market. So it might be time to get some exposure to the market, but we want to make sure that the VIX continues to go down, or at the very least doesn't go up significantly. I probably won't make any recommendations until after the 1st of February, after the next Fed meeting, because I do want to see what the Fed is doing. And on the assumption that the Fed increase is only 25 basis points, we'll probably that's probably a good green light for getting back into the market. What this means, by the way, as the VIX comes down, is that institutional investors are expecting volatility to continue falling over the next 30 days. The VIX is a futures contract, by the way. We haven't talked a lot about the actual contract itself, but it's a futures contract, very similar to oil or gas or any other type of futures or commodity. Even though this is not a commodity, it's just a futures. It's basically saying, as the VIX falls, it implies that over the next 30 days, volatility is going to decrease in the markets. So institutional investors are kind of hoping or counting on the fact that there's going to be less volatility. Now remember, the institutionals, that's the big guys. That's the mutual funds of the world, the pension plans and stuff. They don't like volatility. It's just the opposite with us, though. We like volatility. The options market works best when there's a lot of volatility, or higher. I shouldn't say a lot, because sometimes it can get too much. But when the volatility is higher, that's where there's a sweet spot for us. When the VIX is at, say, 25, maybe 26 or something, that's a good number for us. As that VIX number comes down, the volatility slows down a lot, and it's more calming for people who are managing retirement plans and 401ks and stuff. But for us in the options market, we like the volatility. So we're kind of hoping in the back of my head, I'm kind of hoping that the volatility will spike back up, because we can make a lot more money with a higher VIX than we can with a lower VIX. And I don't want to make it sound like we can't make money. We can. It's just, again, the runs are going to be smaller. So, we have to do more trades trying to get 10 or 15 cents, and then we have to get out. Whereas in the past, maybe we get into a trade and hope for, or try to get 30, 40, 50 cents. So it gets a little harder to stay in a trade for a longer period of time as the VIX comes down. This is the market, and this is the opposite. Now, this is the actual spider market, or the SPY, which is the ETF for the S&P. So the S&P, as you can see, kind of those same periods of time. I didn't show it all through July and June, but you saw that increase. I told you the market was increasing right up until about mid-August. And then mid-August, the market started coming down. So you can kind of see that here on the screen. So you can see the market coming down from mid-August, goes down to about the 10th, or maybe let's call it the 15th of October or so. So mid-October, and then the market tries to rally back. And it does to some extent. It didn't get back to its other highs. That's one of the reasons we don't think that the market's going to continue to go up from here. In a rally, you want to see higher highs and lower highs, or higher lows, rather. So we didn't see that. So the market in December, it did come back up. It came up to about the 4. You can see it over there on the right, about the 405 level. But the previous high was at 420. So we're 15 points below the previous high. From a technical standpoint, that means that the market didn't reach its previous high. So there seems to be some resistance up here to prevent the market from going any higher. Now we are right now at 398, so we're kind of climbing back to that December high. If we can break the December high, there's a good chance we can get back to that high in August, about August 15th or so at the 420 level. Whether we get there or not, don't know, and we're not going to predict it. We don't trade that way, but we're just simply going to watch and see what happens. But what I want you to see is notice what all the stuff on the right-hand side of the slide. It's mostly moving sideways. And that kind of goes with what we saw over there on when I showed you the VIX chart. The market is trying to push higher, and it is making some success. We had a low, the most recent low here, about a 375. We're back up to almost 400 on the S&P, or SPY rather, the spider. So the market is trying to get higher, but it's been slow. You can see it's not been a straight line or a steep line like we had in the previous sections. So it's kind of taking its time. Again, that's another indication that there's not a lot of momentum with the bulls, and the bears are putting up a pretty good fight. But the bulls do have the momentum for the moment. So I think that this is going to continue going up a little bit. We've got to get to 405 before we can make any real decisions. We'll probably see that. I'm kind of thinking in my head probably before the Fed meeting in February. But at the end of the day, again, we don't really know what's going to happen tomorrow. We don't know what's going to happen in 5 minutes from now. But at the end of the day, I think this is going to get back to 405. And if it gets to 405, it's going to try like crazy to get back to 420. And if it does, we could rally from there. And I don't know whether we'll get back to our previous highs that we saw in January of last year, December and January of last year. But I think the market's going to try real hard. But in any event, that's what I wanted to show you on the slides here. Here's what it means. The market is attempting to rally. So while the market may rally, volatility can reappear very quickly. Remember, this is something where the VIX can shoot up in a moment. It only takes one comment from somebody, or maybe an interest rate increase that's bigger than expected, or maybe some exogenous thing happens in the marketplace where maybe there's a hurricane or an earthquake somewhere and it destroys things, or maybe the war in Ukraine gets worse, or maybe China attacks Taiwan. Who knows? There's a lot of things that could happen that could precipitate a huge increase in the VIX. I don't see anything on the horizon, but we're always looking for it to see if it happens. For the moment, we'll likely experience more frequent trades for smaller gains. So again, the way to counter this is we're going to start making more trades, just as big. We're still going to do the 1,000 contracts, maybe even 5,000 contracts, but we're not going to be holding as long. So we're looking for 10, 15, 20 cents. We get out of the trade, look for the next one. So we'll do more frequent trades. It does increase our trading costs, but unfortunately with the lower VIX, that's really the only way to survive. It does increase our costs, but to make the kind of money that we're used to, it's what we have to do. So I just wanted to get you guys an update on what the VIX is and where it's heading and all that stuff. So if you have any questions, again, give me a call, send me an email, text, whatever. And otherwise, we'll see you next time. Thanks.